G'day Gain Squad. I am so glad you could join me for today's deep dive into the absolute chaos we are seeing. Let's see where the smart money is flowing today, because fair dinkum, the markets have been doing backflips since Monday morning. We are covering the heart-stopping gold crash to $4,000 and the cheeky little recovery we are seeing right now. We'll also look at those incredibly sus billion-dollar trades that happened just minutes before the big news hit the wires yesterday. Then we'll check if the tech giants are losing their puff and if oil is going to keep our gains under pressure. Just a quick heads up that I am not a financial advisor, so please do your own homework before placing any trades. So, gold getters, here is the big question. Is this bounce for real, or are we about to get another massive slap? Let me know what you think in the comments, and don't forget to hit like and subscribe to keep the channel growing. The market's having a bit of a wobbler this week, and Monday, March 23rd was a proper nightmare for anyone holding long. Spot gold absolutely cratered, falling all the way to a 4-month low of $4,098.87 per ounce. It was the worst weekly performance we have seen for the metal since the 1980s, down 20% from the peak. Everyone was panicking as the price sliced through support levels like a hot knife through a tub of margarine on a Sunday. But hold your horses, because as of Wednesday, March 25th, the price has managed to crawl back up to $4,470. This rebound above the $4,450 mark is giving us some hope that the worst might be over. This is a proper golden entry for the brave souls who bought the dip while everyone else was running for the hills. The recovery is mostly driven by the fact that tensions are still high and people want something physical to hold on to. We are seeing a bit of a tug of war between short-term sellers and the long-term smart money who are looking for value. It's been a wild ride, with the price swinging by over $200 in just a few hours of trading. If you aren't careful, this kind of volatility will leave you as flat out as a lizard on a sunburnt rock. Let's optimize this entry by looking at why the big institutions decided to dump their bags so hard at the start. We saw a massive institutional sell-off where the big hedge funds were liquidating their gold positions to find some quick cash. Roughly 62 metric tons of gold flowed out of exchange-traded funds in just the last few weeks of March. The big players are worried that higher oil prices will force central banks to keep interest rates much higher for longer. When rates go up, the opportunity cost of holding gold rises, making yield-bearing assets look a bit more attractive to banks. This caused a massive flush out of leveraged traders who were betting on $5,000 being a solid floor for the price. It was a classic liquidation event where everyone was selling everything that wasn't nailed down to cover their other losing trades. The US dollar index, or the DXY, also hit a 10-month high, which acted like a lead weight on gold prices. Since gold is priced in greenbacks, a stronger dollar makes it more expensive for everyone else in the world to buy. But don't forget that these massive sell-offs often lead to extreme oversold conditions that the smart money loves to exploit. We are keeping our positions tight because the institutional flow is starting to stabilize as the price finds its new range. Now, we have to talk about some very dodgy activity that has everyone on Wall Street and Reddit absolutely fuming today. Just 15 minutes before President Trump announced a delay in military strikes, someone bet $500 million on oil. They placed bets on over 5,000 lots of crude futures, selling at the top right before the market completely tanked. Not only that, but a mystery $1.5 billion bet was placed on stock market futures at the same time. It's enough to make you wonder if someone had an early look at the president's Truth Social feed before it posted. These traders bought the stock market at the exact low and sold oil at the exact high of the entire day. Some politicians are already calling this mind-blowing corruption and demanding an investigation into who exactly made those perfectly timed trades. When you see billions moving 5 minutes before a major policy tweet, you know the game isn't exactly fair play. These mystery bets were worth a massive payout once the news hit and the S&P 500 futures surged higher. It shows that even when the market's having a bit of a wobbler, someone out there is making a killing. As gold getters, we have to stay alert to these weird moves because they usually signal that a big reversal is coming. It's a bit of a dog's breakfast for the regulators who have to figure out if this was luck or inside info. Either way, the timing was perfect, and it completely changed the momentum of the trading session for every major asset. This kind of activity is exactly why we watch the order flow so closely to see where the big dogs are. It's a wild world, but keeping your eyes peeled for these sus moves can save you a lot of heartache. The main reason for the sudden shift was Trump's announcement of a 5-day delay on strikes against Iranian power plants. This news diffused the immediate time bomb, but the clock has basically just been reset for this coming Friday afternoon. The markets are in a weird holding pattern while we wait to see if the USS Tripoli actually reaches the Gulf. Iran has been talking tough, denying that any negotiations are actually happening and calling the news psychological warfare to lower oil. So we are stuck in this narrow diplomatic window where anything could happen at any moment to spark a move. Uncertainty is gold's best friend, but this specific type of uncertainty is actually making the US dollar stronger for now. If the Friday deadline passes without a deal, we could see gold spike back toward $5,000 very quickly. Traders are watching the news headlines like hawks, ready to jump in the second a new update hits the feed. The risk of a multi-country escalation is still very real, with reports of fresh strikes in the Isfahan region recently. It's a proper high-stakes game of chicken between Washington and Tehran, and the financial markets are caught right in the middle. Make sure you have your stops in place, because a single tweet could move the price by $100. We are looking for any signs of a real ceasefire, but for now, it's just a temporary pause in the biff. The operational environment is incredibly volatile, and you don't want to be caught on the wrong side of the news. Keep your cool and wait for the high probability setups rather than chasing every little headline that pops up on your phone. The smart money is waiting for Friday to see if the de-escalation is a real thing or just a fake-out move. Let's talk about oil, because WTI crude has been jumping around more than a roux in a veggie patch. Oil prices hit a 4-year high near $100 a barrel on Monday, before crashing down to $86. The OVX index, which measures oil volatility, has been sitting above 90, which is a massive level of market stress. When oil prices surge, it creates the oil shock paradox, which actually puts a lot of downward pressure on our gold gains. This is because high fuel costs drive up inflation, which makes the central banks act like a bunch of angry magpies. They start talking about raising interest rates even more, which makes the non-yielding gold look a bit less shiny to investors. We saw Brent crude fall 15% in minutes after the Trump announcement, which was a massive relief for the global economy. But the energy market is still very tight, and any new strikes on refineries could send prices back to the moon. Saudi Arabia and the United Arab Emirates are also getting nervous, which is adding to the overall geopolitical risk premium. If you are trading gold, you absolutely must have a chart of WTI oil open on your second screen right now. The correlation between energy and metals is the strongest it has been in years because of this conflict in the Middle East. High energy prices are a direct threat to global growth, and that usually leads to a flight to the US dollar. We want to see oil stabilize below $90 to give gold some room to breathe and start its next leg. Until then, the volatility in crude is going to keep the entire commodity sector on the edge of its seat. It's a tough environment to navigate, but that is why we are here to optimize every single trade we take, now. For some long-term perspective, the de-dollarization trend is still going strong despite the short-term price drop we saw. The People's Bank of China has just extended its gold buying streak to 16 consecutive months, as of March 26th. They now hold over 2,300 tons of gold, which is a massive 10% of their total reserves. There is even some spicy talk on Reddit about the US Treasury paying off debts to China using physical gold bars. This golden yuan narrative is a big reason why many central banks are moving away from the US dollar lately. Emerging markets like India, Turkey, and Brazil are also stacking gold because it has zero counterparty risk in a war. They bought over 1,000 metric tons last year, which creates a huge structural floor for the price of bullion. So even if the price dips to $4,000, these massive sovereign buyers are waiting to scoop it all up. It's a slow-motion shift in the global financial system that makes gold a must-have for any serious long-term portfolio. The US dollar's dominance is being challenged like never before, especially with Iran wanting Chinese yuan for their oil shipments. If the petrodollar system starts to crack, gold is the only asset that can truly protect your purchasing power. We aren't pricing in a total dollar collapse yet, but the insurance value of gold has never been higher than today. The smart money knows that fiat currencies are being debased, and they are using this dip as a strategic entry point. Don't let the short-term noise distract you from the fact that the world is moving toward a gold-backed future. Keep stacking your gains in real assets because the long-term trend is still firmly in our favor as gold getters. Let's look at the equity markets, because the Magnificent 7 tech stocks are having a bit of a rough time. The Mag 7 magic is starting to fade as investors demand real receipts for all the money spent on AI. Nvidia is still the king, but even they saw a bit of a pullback this week as the tech bubble starts to hiss. Apple is feeling the pinch because the cost of gold and silver for their circuitry has literally doubled in 2 years. They use a lot of bullion in their hardware, and high prices are starting to eat into their profit margins. Tesla is also struggling with its valuation, leaving very little margin for error as interest rates stay higher for longer. We are seeing a rotation out of overvalued US tech and into more defensive global assets like gold and silver. If the AI bubble finally pops, there will be a massive wave of liquidity looking for a safe place to hide. All roads eventually lead back to gold when the stock market starts to look like a house of cards. The S&P 500 account for a huge portion of global wealth, and a correction there would be huge for us. The Magnificent Seven profits are expected to grow much slower in 2026 than they did in the previous years. This means the automatic outperformance of tech might be over, and traders are looking for new themes to play. Watch the tech charts closely, because a breakdown in Nvidia would be the ultimate green light for a gold rally. We are seeing a re-rating of risk across the board, and tech is no longer the safe haven it once was. This is why we keep a balanced view and always look for where the real value is hiding in the market. Alright, let's optimize this entry with the technical indicators for Wednesday, March 25th on the daily and 4-hour charts. The Relative Strength Index, or RSI, has bounced from an extreme oversold reading of 27 up to around 50. We are currently facing a death cross on the daily chart where the 20-day moving average has crossed below the 50. This is a bearish signal that usually warns of more downside, but the 200-day EMA at 4,200 held. Gold is currently riding the lower Bollinger Band, showing high volatility and that the sellers are still very much in control. We saw a hammer candlestick pattern form at $4,114, which is a classic sign of a bottom. MACD is deep in negative territory, but the histogram is starting to shrink, meaning the bearish momentum is finally starting to fade. Immediate resistance is at $4,500, and we need a clean break above that to confirm the recovery. If we fall back below $4,300, then we might be looking at a retest of those $4,000 lows. To wrap up the main points, gold had a shocker of a crash to $4,000, but is bouncing back. Those sus billion-dollar trades before the Trump tweet have everyone asking who exactly knew the news was coming. Oil prices have dropped to $86, but the volatility remains extreme, which is keeping the inflation fears alive. Trump's 5-day pause on strikes gives us a little breathing room until the Friday deadline hits the market. China and other central banks are still buying the dip, which provides a massive long-term floor for the gold price. Big tech is looking shaky, and the rotation into safe havens like gold is starting to look like a smart play. The technical indicators say we are still in a bearish trend, but an oversold bounce is currently in progress. So, smart money, do you reckon this is the start of a massive new bull run, or just a trap? Give us your best guess in the comments, and tell me if you are buying or selling this crazy volatility. Make sure to like the video and subscribe to Goldie Gains so you stay ahead of the curve every single day. Keep your positions tight, and gains golden. I'll see you at the next close. Cheers. Stay active, stay legendary. Catch ya.